The stock market is one of the most powerful tools for wealth creation. But for beginners, it can appear confusing and intimidating. The complexities of choosing individual stocks, understanding market trends, and managing risks can deter newcomers from starting their investment journey. Many people avoid investing out of fear or uncertainty, missing out on the opportunity to build wealth over time. Despite these challenges, stock market investing remains one of the most reliable ways to achieve long-term financial goals. The key for beginners is to start with investment vehicles that simplify the process while offering robust returns. Index funds and exchange-traded funds, ETFs, serve this purpose well. These passive investment tools allow investors to access a broad range of stocks without having to engage in the time-consuming and often stressful task of picking individual stocks. They are structured to provide diversification, minimize costs, and reduce risk, making them ideal for those who are new to the world of investing. In today's video, we will explore why index funds and ETFs are considered the best investment choices for beginners. We will examine their advantages, how they work, and why they are a superior choice for those who lack deep knowledge of the stock market. An index fund is a type of mutual fund, or ETF, designed to track the performance of a specific stock market index. An index is a collection of securities, stocks, that represents a particular portion of the market. For instance, the S&P 500 index includes 500 of the largest publicly traded companies in the United States. By investing in an index fund that tracks the S&P 500, an investor effectively owns a small portion of each of these companies. Index funds aim to replicate the performance of the index they track, rather than trying to outperform the market. They are passively managed, meaning they don't require a fund manager to actively buy and sell stocks. This results in lower costs and fees compared to actively managed funds, where a fund manager attempts to beat the market through stock picking. ETFs, or exchange-traded funds, are similar to index funds, but are traded on stock exchanges, just like individual stocks. This allows investors to buy and sell ETFs throughout the trading day at market prices, offering flexibility. Like index funds, ETFs provide exposure to a wide array of assets within a single investment. ETFs can be designed to track different indices, sectors, or market segments, providing investors with opportunities to diversify their portfolios across industries or geographies. They are highly liquid and usually have lower fees than traditional mutual funds, making them accessible to beginner investors. Stock picking involves researching and selecting individual companies to invest in, which requires a deep understanding of a company's financials, market conditions, and future prospects. This approach can be rewarding, but is also risky, especially for beginners who may not have the time or expertise to evaluate each stock effectively. Index funds and ETFs eliminate the need for stock picking by allowing investors to buy shares in a fund that holds a diverse basket of companies. For example, an S&P 500 ETF allows an investor to own a piece of 500 companies with a single purchase. This approach simplifies investing and significantly reduces risk by spreading investments across many stocks. Index funds and ETFs come in a variety of types, each designed to track different parts of the market. Broad market ETFs track an entire stock market index, such as the S&P 500 or the total stock market. Sector ETFs focus on specific sectors of the economy, such as technology, healthcare, or consumer goods. International ETFs provide exposure to foreign markets, offering geographical diversification. Each type of index fund or ETF caters to different investor preferences, allowing beginners to customize their portfolios based on their risk tolerance and investment goals. Diversification is one of the fundamental principles of investing. It involves spreading investments across a variety of assets to reduce the risk that a single poor-performing investment will significantly impact the overall portfolio. Index funds and ETFs provide instant diversification because they hold a wide range of stocks within a single fund. For example, an investor who buys a share of a total stock market index fund gains exposure to thousands of companies across different industries. This broad diversification reduces the risk of losing money due to the underperformance of one or two individual companies. For beginners, this protection against concentrated risk is essential. One of the significant advantages of index funds and ETFs is their low cost. Actively managed mutual funds typically come with higher fees, as they require professional fund managers to analyze markets, pick stocks, and make frequent trades. These fees, known as expense ratios, can reduce an investor's net returns over time. In contrast, index funds and ETFs are passively managed, meaning they simply track an index without the need for active trading. This results in much lower fees, often less than 0.1% of assets under management. For beginners, these cost savings are critical because fees can compound and erode long-term returns. Index funds and ETFs are straightforward and easy to understand. Rather than dealing with the complexities of stock selection, market timing, and constant monitoring, beginners can buy a single fund that provides exposure to a broad segment of the market. This simplicity makes them accessible to anyone, regardless of their financial knowledge or investing experience. Furthermore, many brokerage platforms offer commission-free trading for ETFs, making it easier and more affordable for beginners to start investing with small amounts of money. These platforms often allow for automatic investments, helping beginners stick to a disciplined strategy without the need for frequent manual intervention. Actively managed funds employ portfolio managers who try to outperform the market by selecting stocks or other assets they believe will deliver higher returns. However, research consistently shows that most actively managed funds fail to outperform their benchmark index over the long term. This is due to a combination of higher fees, poor timing, and the difficulty of consistently beating the market. Index funds and ETFs, on the other hand, take a passive approach, seeking to match the performance of the index they track. While this may seem less ambitious, it has proven to be an effective strategy for building long-term wealth. For beginners, who are often better served by consistency and low costs rather than attempting to beat the market, passive funds are an ideal choice. Historically, the stock market has delivered strong returns over the long term, averaging around 12 to 15% annually. By investing in index funds or ETFs, beginners can tap into the growth of the overall market without the need to actively manage their investments. Over time, the compounding of returns can lead to significant wealth accumulation. The key is staying invested for the long haul, rather than trying to time the market or chase short-term gains. Index funds and ETFs are perfectly suited to this long-term approach, as they are designed to deliver steady market-based returns. One of the most common mistakes beginner investors make is attempting to pick individual stocks without the necessary knowledge or experience. Stock picking requires understanding a company's financial statements, competitive position, and future prospects, which can be overwhelming for those new to investing. By investing in index funds and ETFs, beginners can avoid these challenges. Instead of trying to pick the next hot stock, they can invest in a diversified portfolio that captures the growth of the overall market. This reduces the risk of making poor investment choices based on limited information. Investing can be an emotional experience, especially when markets are volatile. Beginners may be tempted to sell their investments when markets decline, only to miss out on the recovery when prices rebound. This cycle of buying high and selling low is one of the biggest reasons individual investors underperform the market. Index funds and ETFs help mitigate emotional investing by promoting a long-term, hands-off approach. Since these funds are passively managed and designed to track the market, investors are less likely to make rash decisions based on short-term market movements. This disciplined approach helps beginners stay focused on their long-term goals. The concept of compound interest is one of the most powerful forces in investing. It refers to the process by which investment returns generate additional returns over time. For example, if an investor earns 10% annually on their investment, they don't just earn 10% on their initial principal each year. They also earn returns on the returns from previous years. Index funds and ETFs are well suited for taking advantage of compound interest because they are designed for long-term growth. By staying invested in these funds over time, beginners can harness the power of compounding to grow their wealth steadily. Many beginners are drawn to the stock market by the allure of quick profits from speculative investments. However, trying to time the market or invest in risky, high-growth stocks often leads to disappointment and losses. Index funds and ETFs offer a more consistent, reliable approach to investing. Rather than chasing the latest market trends, they provide exposure to a broad range of assets that deliver steady, market-based returns. For beginners, this consistency is crucial because it reduces the likelihood of making costly mistakes driven by speculation. Start investing with Scalable Capital, trusted, reliable, and regulated for Europe. Ready to grow your wealth? With Scalable Capital, Europe's leading digital investment platform, investing has never been easier. Whether you're just starting or a seasoned investor, this app provides safe, reliable, and fully regulated investment opportunities tailored to your needs. Scalable Capital, I use for my personal investments because it is trusted and secure, fully licensed and regulated under European financial standards. User-friendly, invest in stocks, ETFs, and more, all from an easy-to-use app. Expert guidance, benefit from smart algorithms and professional insights. Low costs, transparent pricing with no hidden fees. Start investing today with confidence and take control of your financial future. Download the Scalable Capital app now and join thousands of Europeans already growing their wealth. To wrap up, remember that investing doesn't have to be complicated or overwhelming. With index funds and ETFs, beginners can enter the stock market with confidence, relying on time-tested strategies that prioritize long-term growth, diversification, and low costs. Instead of getting caught up in the noise of daily market swings or trying to pick the next big stock, focus on building a consistent, disciplined approach that will help your wealth grow steadily over time.